Hi, I'm Brett from Metropole. Well, are you a sucker for a juicy clickbait headline just like me? Maybe like the one I've just used. A promise of endless cash flow would have to be the most hyped property headline in advertising. After all, who doesn't want more cash flow in their lives? It's the bait that lures you in the hope that the salesman will snap you up. But as I'll explain shortly, cash flow, positive or negative, is merely an outcome. It's not a strategic way of investing. It's a very superficial way of looking at investing and only takes into consideration one of a multitude of factors. I would also argue, whilst important for mine, cash flow must be a secondary consideration. There's always an argument around capital growth versus cash flow in all property circles, but in my opinion, it is a non-argument. You see, the theory is pretty simple to explain. After you've received your rent, you've paid your mortgage and your body corporate fees and everything else, you're left with a profit, maybe $2,000, $5,000, $10,000, and do it often enough and magically you can replace your income. The theory is probably shot down a little bit when you've got to consider you're taking and paying tax on that. There's other fees and associated costs with property investing involved as well. Quite often it leads to opportunities where the property isn't growing in value, but hey, it's not costing me anything. And that's a common phrase we hear from our clients. You see, we can achieve the same outcome by manipulating the inputs. We can put down a larger deposit. Even though we're getting less rent, we can pay interest only. It's going to change the outcome and get you to more of a cash flow positive or neutral. So that is why it needs to be a secondary consideration. Many salespeople tend to target that. You've got to understand residential property is historically a high growth, lower yielding asset. When you're starting to buy off the plan, brand new, chasing cash flow with rental guarantees, looking for dual occupied properties, putting granny flats in backyards or buying in regional areas with high rents, you're inheriting a great deal of risk and you're being compensated with a higher rental yield. And quite often, it's a significantly lower growth. It may not seem like a lot, but in a recent case study, I looked at two investors who invested $1 million in a residential property. One was getting 7% per annum capital growth with a 3% rental yield, escalating with inflation at 2.5%, while the other investor who spent $1 million went the other way. He bought one of these cash flow assets that was giving him a fantastic 6% rental return, but only giving him 4% capital growth. And it may not sound like a lot either way. It's not going to tip the scales too much, but I can tell you over a decade, it was more than $150,000 in favour of investor A. And over 20 years, it was $900,000. Now, while you don't have access to the numbers then, you're going to have to take my word for this. There's a clear winner there. The big picture tells us that it's capital growth that is king. That can be life-changing. I always tell my clients the most important property for you when building your asset base is the one that gets you into your property quicker. By having more equity and greater cash flow with those types of assets, that's what's going to help you build your property portfolio over the longer term and also help you build substantial wealth. So follow a proven framework and a proven system. Don't start with a property or an outcome and follow a trusted and proven method. Don't go off a gut feel or a hunch or a short-term decision. Factor it out over the longer term. Use a well-known strategic planning and strategic decision-making process like we use, and let the facts and the data and the numbers tell the story. Thanks for watching.